Hey everyone, it's Richard. You're watching The Plain Bagel. As you probably saw, this past Wednesday, we had the big day, the so-called Liberation Day as coined by Donald Trump, whereby the United States was going to announce a new slate of tariffs in response to what it believed were unfair trading practices from other countries. And if you keep any sort of tabs on the stock market, you're probably aware that for investors, it didn't go so well. The only thing they saw themselves being liberated from was their capital gains, with the S&P 500 dropping over 10% over the past 2 days. And outside the general negative sentiment around rising tariffs from the United States and retaliation to those tariffs, most recently from China, what's most shocking with all this is how aggressive the newly announced tariffs are on some countries and the bizarre method used for coming to these rates. So today I want to quickly go over what happened, why we're seeing such a drastic impact on the stock market, what's been so controversial about how these tariffs were calculated, why we're seeing penguins protesting all this, and overall just give some input on the situation. Because I know that whenever we see the market drop by this amount, a lot of people get very nervous and want to understand the story behind these drastic stock market movements. So hopefully this will help clear some things up. And yes, I know I'm trying to move away from discussing White House announcements, but I'll stop posting about tariffs when they stop impacting the market so much. Like, I don't want to be here either. I don't want to be talking about tariffs every video. But at this point, they're one of the biggest factors for investors, or at least the most visible factor that investors are faced with. So I do think it warrants diving into. But let's start at the beginning with what exactly happened here. Ever since coming to power, Donald Trump has really lambasted the trade relations that the United States has with many of its trade partners, arguing that the US faces unfair trade practices. And because the US has a general trade deficit whereby the country is buying more goods than it sells to its trade partners, that this was hurting the US economy and was ultimately unfair. And we already saw before April a number of moves by the Trump administration to try and remedy that, with them imposing tariffs on a number of key trading partners, including Canada, Mexico, and China. But for a while now, April 2nd has been highlighted as a date where things were likely to escalate, with Trump having ordered the review of current trade relations, with the report for that analysis being due the day before. So even before this date, we had already seen a bit of a stock sell-off, with the S&P 500 dropping roughly 8% from around February 18th, with markets seemingly pricing in an expectation of a 10% flat universal tariff on US imports. However, it turns out that the announcement ended up being a bit more drastic. While the Trump administration did move ahead with a flat 10% universal tariff on imports into the country, they also highlighted a good chunk of other countries that they deemed to be the worst offenders in terms of trade practices, who were slapped with even larger tariffs. With during the announcement on Wednesday evening, Trump actually pulling out this massive poster listing out all the tariffs by the country, with one column on these posters highlighting allegedly what the countries were charging on US imports, inclusive of, quote, currency manipulation and trade barriers, and the rightmost column highlighting a so-called discounted tariff that the Trump administration was going to retaliate with this amount simply being half of the alleged tariff. With the flat 10% tariff due to come into effect April 5th or Saturday, and the reciprocal tariffs due to come into effect April 9th. And most of the countries in this list were hit with pretty high levies. We saw the European Union slapped with a 20% tariff, Chinese goods seeing a 34% tariff in addition to the already announced tariffs, meaning that Chinese goods now face over a 50% tariff when they enter the United States, and some countries even seen a tariff as high as 50%. Now, interestingly, even though 2 days earlier, the White House highlighted that there would be no exemptions to this new list of tariffs, we have some exemptions here. Namely, Canada and Mexico were able to avoid tariffs this time around, meaning that they're only subject to any tariffs that have already been announced to date. And later, the White House highlighted that certain products and commodities, namely copper, pharmaceuticals, semiconductors, lumber, gold, energy, and certain materials, would also not be impacted by these new tariffs. But overall, even with these exemptions, the average effective US tariff rate is now expected to increase, according to the budget lab at Yale, to 22.5%, compared to just 2% last year, and representing the highest rate we've seen since 1909. Which naturally has many people concerned that the severity of this new tax is going to push the country of the United States and many of its trade partners into a recession, especially given how globally integrated supply chains have become over the past few decades, given the period of low tariffs we've generally had between developed nations, and B, in the past when the United States has imposed such broad tariffs, it hasn't generally gone well, with many citing the Smoot-Hawley tariffs of 1930, which are largely blamed for prolonging the Great Depression. So you can see why stocks have reacted so negatively to this update. And while the US Secretary of the Treasury, Scott Bessent, has urged countries not to retaliate with their own tariffs, Naturally, it seems like many are planning to do exactly that, with many world leaders not just declaring their own intent to retaliate, but a number of countries even working to collaborate on their own response, with most notably China, South Korea, and Japan all agreeing to strengthen trade ties and seemingly discussing the idea of addressing tariffs together. So fair to say that whether you're talking about investors or other trade partners around the world, move's not been very popular, to say the least. But one of the more controversial aspects about this announcement is how the United States got to these tariff rates that it's now charging on its trade partners. You see, for a while, Trump has been presenting these tariffs as being reciprocal. The idea that if your country is going to charge tariffs on our imports, we're just going to turn around and return the favor in kind, which naturally is a pretty easy idea to defend politically. But one, many have accused Trump of actively misrepresenting the tariffs that other countries actually charge on US imports. And it's just generally pretty difficult to summarize a country's entire tariff regime with a single rate, unless you're doing something like the effective tariff rate on what's actually being charged, which these rates don't seem to reflect here. So while the US might accuse Japan, for example, of charging a 46% tariff on US goods, that does seem pretty misrepresentative, especially given that the country's effective tariff rate is only around 3.2%. But more shockingly too, after the announcement, the White House released in a publication how it calculated the tariff rates for all of these trade partners. And it turns out tariffs aren't even part of the formula. You can see the calculation here, and it probably looks pretty sophisticated. We have some Greek symbols. We even have variables for price elasticity and the price pass-through of tariffs onto consumers. But funny enough, using the White House's assumptions, these two factors, which give any sort of semblance of sophistication here, actually cancel each other out, given that they multiply 4 by 0.25, which leaves us with a formula of the country's net exports to the United States over their imports from the country. In other words, even though the tariffs are supposed to be reciprocal to the exporting country's own tariffs, currency manipulation, and trade barriers, in reality, they are entirely based on a country's trade balance with the United States, or how much they sell to the US versus how much they buy. Which really falls in line with the idea Trump seems to have that trade balances are equivalent to a subsidy, or any situation where one country is buying more from another is unfair, with the White House justifying this by arguing that any persistent trade deficits are going to be due to some form of trade barrier, which is a pretty broad assumption. There are certainly circumstances where a country can contribute to a trade imbalance by, say, subsidizing an industry so that their product is more competitive or cheaper than a foreign product, which can domestically within that foreign country cause issues. But there are a number of other variables that I wouldn't necessarily describe as trade barriers. Things like, say, cheaper labor or the lower cost of living in one country versus another, climate that might impact agricultural produce and give countries different advantages in different areas, and just generally what one country has to offer and what they need versus what the United States has to offer and what they need. Any sort of misalignment there is just going to naturally lead to a trade imbalance that might not necessarily be the result of unfair trade practices. For example, Madagascar, which is described by the International Trade Administration, a US institution, as not having significant formal non-tariff barriers to trade, and whose only levy seems to be a 20% value add tax on imports, is shown here as charging a 93% tariff and being subject to a 47% tariff, all because of their large trade deficit with the United States, which makes sense because the average monthly salary in Madagascar is around $230 a month. So it makes sense that we'd see wealthier American households and companies buying more cheap products from Madagascar than we'd see Madagascar companies and households buying from the United States. Again, trade deficits can be a signal of a country's prosperity. But what's been highlighted as even more ridiculous with all this is the fact that some of the countries targeted with these extended tariffs don't even have human populations, with lists including Heard and McDonald Island, a territory whose population is mostly penguins and which hasn't been inhabited by humans since the 1950s. Which, if there's any silver lining to all of this, it's that we've at least got some really good memes and jokes around this circulating online. Nonetheless, that's the reasoning given for the specific tariff rates we saw announced on April 2nd. So what's the damage? What can we expect to happen as a result of these tariffs? Well, naturally, when it comes to estimating any sort of economic impact, pretty near impossible to do so accurately. There's just too many variables, too many parties involved. We have the tariffs and how companies and consumers will react to those, as well as any reciprocal tariffs and what we'll see come from other countries in response to this announcement. So very difficult to forecast any of that. But we do have some figures being proposed here anyway, or forecasted, with me specifically relying on the budget lab at Yale for these figures. And one of the most visible variables and upfront impacts will be to inflation, with the budget lab estimating that prices will rise by 2.3% in the short run as a result of all tariffs announced to date, which translates into roughly $3,800 per household, over half of which is related to just the April 2nd tariffs. Meanwhile, real GDP growth is expected to be nearly a full percentage point lower in 2025, and in the long run, after supply chains recover, the US economy is expected to be persistently roughly half a percentage point smaller, which translates into an annual cost of $100 to $180 billion, which, taking these two variables together, does raise concerns of stagflation, the idea of prices rising despite lackluster or flat economic growth. Now, you might be surprised to hear that US GDP is only dropping by 1 percentage point, even though on a dollar basis that is a large drop, despite the stock market dropping by an even larger amount. But unfortunately for investors, the stock market is generally more exposed to trade wars than the US economy as a whole. You see, there is this view that any sort of trade war the United States enters is going to be much more painful for the trade partner than it is for America, given that exports only represent roughly 11% of America's GDP, unlike many other trade partners like here in Canada, where US exports represent a much larger percentage of gross domestic product. However, as highlighted by Canadian economist Stéphane Marion, foreign sales represent 41% of S&P 500 sales, showing that just at the top line, there's a lot of exposure there. Beyond that, of course, companies are also going to see a cost impact based on where they source the products or services that they produce. And certain industries are going to be hit particularly hard. The Budget Lab, for example, has a nice breakdown of which commodities are likely to see a price effect from the April 2nd tariffs, with clothing and textiles being one of the most disproportionately affected, with apparel prices expected to rise 17% as a result of the tariffs. So that's the first thing worth highlighting. The US stock market is going to have different exposures than the US economy. Markets are also forward-looking beyond just a single year, so that's a factor as well. And just generally, markets don't like uncertainty. So whenever we have a risk factor like this, which is political in nature, very difficult to predict how things play out, it's generally going to push money out of the stock market. And outside the explicit cost or inflation related to these tariffs, it's likely to have a pretty meaningful impact on the US economy and lead to a number of changes. Yes, if kept in place, it will benefit certain industries. We could see domestic producers now suddenly shielded from foreign competition that might be cheaper or better quality. And that's going to benefit certain industries. However, generally that benefit comes at the cost of consumers who now face less choice, less competition from companies, which generally increases prices that they have to pay. Less trade would also likely reduce the US dollar's global dominance as a reserve currency, given that a good chunk of dollars held outside the United States comes from trade. So the less you trade, the less dollars other countries are receiving, with us already seeing a bit of a weakening of the US dollar according to the US dollar index. Now, it's worth highlighting that the Trump administration has highlighted these tariffs as being a net benefit to the US economy, given that it will raise tax dollars, with one Trump aide even highlighting that tariffs were expected to generate $6 trillion in tax revenue over the next decade. But as we've talked about before, because that tariff is ultimately paid by US citizens, not the exporting country, that would represent the highest tax hike in US history, which generally not something that would be viewed as a positive for economic performance, as higher consumption taxes will reduce household wealth. And when you account for retaliation and reduced demand, it's likely to be much lower than that figure. With again, Budget Lab putting their own estimate for that decade figure at roughly half that amount before accounting for any new retaliations to the recently announced tariffs. Especially because, as we've seen in the past, as tariffs increase, trade activity tends to decrease, which naturally is going to impact how much tax revenue the government can generate from that trade. In fact, with the Smoot-Hawley tariffs, we saw trade between the US and Europe fall by roughly 2/3 between 1929 and 1932, with overall global trade declining by a similar amount in the 4 years that the legislation was in effect. Now, of course, there we have other variables like the Great Depression, but again, highlights that we've seen this correlation in the past, which means that tariffs are unlikely to provide a sustainable source of revenue for the government. So that's the situation in a nutshell. And of course, we're focusing a lot on the United States here, but a lot of other countries are going to see pretty severe implications from all this as well. It's just that there's 60 plus companies, so would need longer than 10 minutes to cover all those implications. But if you're an investor, someone who, say, invests in the US stock market or just stocks in general, naturally, this could be a pretty stressful event. But if you are someone who's considering selling everything, it's worth highlighting a few things before doing so. For one, it's worth acknowledging that yes, this does meaningfully increase the risk of the US or these other trade partners entering a recession, especially if we see retaliation from these other countries. And it's important that if you, say, invest in individual stocks, that you understand the fundamental exposure you have to that risk, both in terms of the financial health of your company to weather these types of storms and an individual company supply chain and things like that that might have explicit exposure to these different trade barriers. And if you don't have that understanding, or you do find that you have a lot of exposure, that may or may not warrant rebalancing or some sort of action. But it's incredibly difficult to generally time the market, let alone try to bet on the outcome of these trade wars, given that so far to date, the tariffs have been incredibly unpredictable. It's very clear that this is a known unknown, a risk factor that we're aware of, but that is very difficult to incorporate in any sort of calculation. Because for all we know, a month from now, the US could be walking back these tariffs and entering new trade agreements, or we could see an escalation, and again, the US committing to this path of protectionism, with many economists hoping for the former. However, the market is going to price in some of this uncertainty, so selling now means you're selling based off of the lower price that's coming from this uncertainty. And maybe that ends up working out if things end up kind of going down a worst case scenario path, but generally speaking, it's proven time and time again that a long-term focus tends to win out. This isn't the first period of widespread US tariffs, and it's also not the first period of severe uncertainty with the stock market. And generally, we've seen things recover over time. And when you zoom out, you can see that the S&P 500 is roughly flat over the past 12 months. So, well, yes, things are down. If you've invested over several years, there's a good chance you still have a positive return. That being said, to be perfectly clear, if these tariffs do hold out, this is a pretty meaningful shock to the global supply chain and could have pretty meaningful ramifications for the long term. It is, however, dangerous to assume that you're smarter than the market and that you're going to sell when things have already fallen and then just buy back before things recover if there's any sort of positive news. Has historically been a difficult strategy, likely to continue to be so. All that being said, though, we'll just have to wait and see how things play out. Thanks for watching. Again, genuinely, I am trying to move away from just covering tariffs with every video, but with this seeing a lot of stock market volatility around it, I know that some people will look for videos on this topic, and I figured I'd try to cover it without sort of the sensationalist pitch to it. So hopefully this video helped clear things up. If you liked it, if you found it was helpful, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on tariffs or tariff content. Do you want more of this? Should I make a separate plain bagel tariff channel? Let me know in the comments down below. Thanks again for watching, and as always, be safe out there.